Like I said, this is going to be recorded, so one thing I say at the beginning of all these, watch it again as soon as you get this sent to you guys. Really makes it sink in. First time through, it might go over your head, some of the nuances of this strategy. Then second time through, it'll really make it sink in so that you remember it. First time through, like I said, is short-term memory. Second time through, we'll put it into long-term memory. And this is going to be on short strangles. All right, and a couple things to go over real quick. My name's Eric Wilkinson. Some of you may recognize me as the Wolfman from CNBC, Fox Business, or even the Wall Street Journal for my commentary on everything from geopolitical to economic and market analysis. I've been trading my own money for well over 20 years now. I'm not here to tell you I'm going to make you rich or make you a millionaire, but I am here to help you take control of your finances, manage your own portfolio, and most importantly, take control of your own risk. If you guys aren't really taking, John, we'll go over that in a minute. If you guys haven't taken control of your own portfolio right now, you're losing a lot of money in just some of the fees that the mutual funds are charging you, let alone the financial advisor. And you guys will pay yourself off in the long run by taking control of it. You will make mistakes, but in the long run, you won't be making any more mistakes than whoever's taking control of your finances right now. John's asking me, where did I get my nickname, the Wolfman, from? Well, it was Joe Kernan from CNBC started calling me Wolfman, and I think it's because I used to have a lot of crazy hair going on and rarely shaved, so that's where I can only guess it came from. But I've traded it in most markets throughout my career. I've traded everything from stocks, financial futures, commodity futures, currencies, and options on all of those products and in all market conditions. You guys get, I think you're saying, is there a lot of noise in the background? I have a fan on. I can turn that off if you guys, if it's bothering everybody. One disclaimer to go over real quick right now is any opinions, news, research, and analysis, or any other information contained here or material provided by ProTrader Strategies and or associate companies is for general commentary and does not constitute investment advice or solicitation to buy or sell any of these things that we talk about. The reason why is because I can't possibly give you guys a trade recommendation because I don't know your risk parameters. I don't know what's in your portfolios. And I would have to sit down with you for a couple hours and go through everything from your risk parameters to what's in your portfolio, what you guys like to trade in order to give a trade recommendation. Because some of these things could be counterintuitive to what's in your portfolio and what you're already doing. And please do your own homework and remember, past performance of any trading system or methodology is not necessarily indicative of future results. The reason why we got to say that is because we are going to be talking about trades and it may or may not work next time. We're talking about probabilities, and probabilities work and don't work sometimes. So in the long run, probabilities work. It's kind of like with Texas Hold'em in a sense. All right, so this is going to be how to use Strangles, and we're going to be generating income from those. So that's what our goal is play the probability, collect some credit, and create income in our portfolio. And like I said, this is going to be on the short strangle. So a couple of things to note with this short strangle is we're going to be market neutral on this. We really want this strategy to work itself out in the long run. And in order for that to happen, we need to have this underlying trading sideways. And in order to get that to happen, we need to be one standard deviation away on our call and one standard deviation away on our puts. And what is a standard deviation? Everybody's probably seen this bell curve before. And one standard deviation lies right here. And that is going to be equivalent to right around a 16 delta, and the delta is equivalent to probability. So if you've heard of people saying, you know, I think the probability of this happening is about 20%, well, that would be about a 20 delta. So a lot of options traders will even use that jargon in just talking about anything. They might say, you know what, the probabilities of the Cubs going to the World Series is about a 20 delta, or you know, some people might even say it's a 1 delta, which would be a 1% chance of them making it to the World Series. But in this regard, we're going to be looking at right here and right here. So if you thought of this as the, sorry, I'm pointing on my other screen. This is right here. So this is the 1 standard deviation on the calls, let's say, and this would be on the put side, just for the downside thinking and the upside thinking. And what happens is 68.2% of the time it's going to land within this area, and you know, 16% of the time we might get hit on this side or this side. So keep in mind, with a strangle, you can only have this underlying land on one side or the other, right? We could land right in the middle, but we're never going to be in the money on both sides of this strategy. All right, picking the right duration. And picking the right duration really comes into effect when we're going to be trying to get inside this 45 days, because what we were talking about before was the probabilities of it landing. This is going to be where your theta happens. And if you're at all familiar with options, theta is time decay. And we really want to take advantage of this downward sloping theta decay, where it really starts picking up, where the hill starts getting steep. We like to stay away from this area here because there's a lot of other things that go on when you get really close to expiration, but we really want to take advantage of this time decay, that 50% drop in your theta over the course of, you know, 30 days. So I like to get in around 45 days right here, just to get in before everybody else, and then really take advantage of that theta decay. And we're going to need to have the right environment. The right environment is high implied volatility. Now, a lot of people look at implied volatility and high implied volatility as being scary. Well, when there's blood in the water, that's the time that there's the most opportunity to make money, you guys. And when there's high implied volatility, what happens is that theta decay that we talked about beforehand doesn't, the volatility holds up this theta curve. And when that volatility comes out, it comes out rather quickly in most instances, and you're going to get that theta drop happening really quickly. So we want high implied volatility percent, which is going to hold that curve, this curve up here, and not allow theta to happen as when we're trying to get into it. So it's going to have a lot of pent up theta. And when that volatility comes out, this theta is going to rapidly even become more steep, and that the theta, the premiums will come out more quickly then. And we're going to need to pick the right underlying, and the right underlying is going to be something that has a lot of open interest and volume in it. It's not going to be something that is rarely traded. I mean, it could even be something that is traded a lot in the underlying, but we have to have a lot of open interest in the options chain. And some stocks have a lot of volume traded on just the stock, but there's not a whole lot of volume traded in the options. We want a lot of options activity, because when there's a lot of options activity, that means there's more players in there, is what we used to call it on the floor. And if there's a lot of players in there, there's more people willing to give up a penny here and there to get that trade off. And we will benefit from that, because we don't have to give up as much edge to get in, and therefore don't have to give up as much edge to get out. And that giving up that edge here and there, nickels and dimes and quarters, is going to really eat into your profit potential. So make sure that there's a lot of players in there, and there's a tight bid ask, because the more legs you start adding in, the more you have to give up, and that is going to eat into your overall profit. And we want to know our exit strategy before entering this trade, especially with this trade, because it is undefined. And anytime you're trading something naked, you know, you have a lot more risk, but you also have a lot more potential to make money. One caveat that I didn't mention with the right environment. When you have high implied volatility, volatility is the expected move in a sense, and volatility is kind of a fear factor. So when there's more fear in the market, there's more volatility within that underlying. And what we're looking for is that fear to be embedded in there, but it's going to revert back to the mean once something, once the unknown kind of comes out of that, or once it settles down a little bit. So we want to take advantage of that. So an example would be with the crude oil this weekend. There's supposedly this big meeting for OPEC over the weekend, and you know, really the talking heads are going to get together. Some people think they're going to shut off the spigot or at least crimp the flow of oil. Well, at the end of the day, Russia is coming in and everybody else, but the wild card is Iran, and if Iran doesn't decrease their output, nobody else is either. So we have that going on. So there's a lot of implied volatility or fear kind of pumped into all the oil-related products. The other thing is with Brazil this weekend is another big thing. You know, they're thinking about impeaching the president there. What's her name? I can't remember her name right offhand right now. But anyway, so there's a lot of fear pumped into those products as well. And I'll go into that whole Brazil thing here in a little bit. But knowing your exit strategy, this is something that I look at as a chart kind of to think of when I'm going to get out of these. To be quite honest, the more I've been trading, the less I go out to this 35 days to get 80% of my max profit. I'm usually really looking to cover at around 50% of my max profit. I found that that is the time to really start covering it. So I'm going to look at my goal as getting 50% of my max profit. But having said that, if I put this trade on like on Monday and 5 days, within 5 days, I say get, you know, 15% of my max profit, I'm going to cover that trade because the probabilities of me being tested on one leg or another are going to be about 30% probability of being tested. And if I can capture 15% of my max profit within 5 days, or, you know, under 10 days, I'm at 30% of my max profit, I'm going to be covering that. So anytime you get less days here and more percent of max profit here, that's when I'm looking to cover that. Yeah, there it is. Thank you, John. Wilma Rolsoff. I'm sure I butchered her name, but funny thing about her is she really hasn't done nearly as much wrong as everybody else that's trying to impeach her. It's the thieves trying to come after her, but it's a wild story over there. All right, so this is pretty important. You know, if you can get more max profit percent in less days, definitely look to cover this strategy. So when you get this, jot that down, pause it on this slide, and put that on your sticky note around your computer. All right, so for the strangle, the max profit, anytime we're selling option strategies and collecting a credit, the max profit is our credit received. That's the guideline. Like I said, the max profit I'm looking for is 50% of that, or my profit potential, I'm kind of looking at 50% of that to get out. And your max loss, of course, is going to be unlimited because this is a naked strategy. So keep that in line, or in mind. And it's going to be when the underlying is trading less than, or sorry, greater than the short call plus the premium received. So if we are doing this strategy and the call strike is 55 and we collected a total of 60 cents for this, when this underlying trades at above $50.60, that's when we're starting to see our loss. and that goes again for the underside, our short put minus the net premium received. So the short put being maybe a 45 put, we collected 60 cents. So when the underlying is trading at $44.40 and below, that's when we're starting to see our loss. And I kind of briefly touched on that. Our break even is going to be that short call plus the net premium. So when it's trading in that example, our 55 call plus the 60 cents, when the underlying is trading at 55.60, that is exactly our break even. Again, with the 45 put example, minus the 60 cents that we collected, 44.40 is our break even. Does that make sense for everybody there? All right, good. So let's go on to the platform here and check this out. So please, would you ever consider high volatility 50% or more? Yes, that's great point, Nick. I consider high implied volatility percent, which is on my watch list over here. Put in the high, you can go into the gearboxes, punch in implied volatility percent, and you can pull it up here. And as you notice, I have this ranked from high to low over here because this is the first thing I'm going to look at for any of these strategies. Another thing that I'm going to look at with this high implied volatility is something that doesn't have earnings in it, and because we're in earnings season, that's going to be a tough nut to crack. So first thing, look at high implied volatility percent, anything above 50 for ETFs, something like the IWM, the Russell. I'm going to look at 30% or above. So any of those will fit the bill for this one. So underlying, particular underlying, 50% and above, ETFs 30% and above. The reason why I lower that a little bit for the ETFs is because with ETFs, it's a basket of goods. So they kind of negate each other. You're going to have some in that ETF that have high implied volatility, some that don't, and it's going to smooth out the waters a little bit in that. So I will lower it to about 30 for an ETF. And one thing about figuring out this implied, this is the historical and the purple. I don't really look at that very often at all. But the blue is the implied volatility percent. And the way that this is calculated in the algorithm for TOS, it may have a little bit more detail to it, but the way to look at it is you take the fraction, the division table. You have a numerator and a denominator. On the numerator, which is on the top, you subtract where implied volatility is now minus, or the current implied volatility minus the low implied volatility over the last year. So you subtract those two from each other on the numerator, and then on the denominator, you subtract the high from the low, and then you divide those two results, and that's where you get your percentage. Okay, so keep that in mind. And the reason why it's good to do that is because, for instance, back in August when we had that massive sell-off, it spiked a little bit. So it throws off the math, because if it's, say, a black swan event, black swan events are events that very rarely happen. You can take that out of the equation and you will get, a higher percentage based on historical highs, if you will. So if that doesn't rarely, or if that rarely happens, then you can kind of take that out, figure out the math yourself, and sometimes give you a bit more accurate results. That's why that's important. So hey, in the questions box, start throwing out some stocks that you guys usually look at, ETFs also, and we'll run it through the rules as we go along here. And It'll make it a little bit better interactive. Chipotle pulling up right away, Goldman Sachs. So let's look at Chipotle. Chipotle's not been having very good time lately. And Chipotle would work in this regards where it's rallied out, it's come back. It looks like to me like it could settle down. One issue I have with it is we have earnings in there. It is going to have, as you can see, it pulls up here on the list. It's one of the top ones that I have for high implied volatility. So that would work. This would probably be better set up for one of the earnings strangle setups, and I would put that in probably right before or the day before it comes out. It comes out after the market, so I would put it on the 26th maybe, and it'll allow you to get a little bit further away from it where it's trading. Let's look at Netflix and see if they got some earnings. And I think they do too. Their earnings actually look like they're coming out on the 18th. So those come out, is that on Monday? The 18th? Yeah. So that one probably wouldn't do it unless it was going to be on a earnings trade. All right, I'm not going to mess with that right now. All right, so Netflix I wouldn't do. We got BRX. Let's see. Valiant. I don't know if they just had earnings, but why would they be having earnings again right there? Unless that was, seems rather quick to have their earnings come out again, unless that's a special call or something. So we could look and see if they are really expected to have those. And one thing to look at here is to try and find the implied volatility when it spikes is usually when it's far out when they're going to be having an earnings call, and that looks like it is going to land in there. So this is something that I probably wouldn't really look at either. SPY has pretty low implied volatility right now just because we've kind of been trading sideways, 4%. I mean, that is at the super low end of it, so that would be something I would probably not do. Other than that would be something that would be a candidate for buying, something like that. I'm short some calls in there that I've talked about in the daily market commentaries that I've just been rolling out. They're in the money, and I just roll them. I'm rolling those out just to collect more credits. So yeah, upcoming Netflix earnings. So that one we're not going to look at doing. Roger's asking, I set up a strangle on Netflix. Why shouldn't you do it before earnings? Wouldn't it increase your probability of success for this type of trade if the IV is higher than historical? Great question, Roger. Or sorry, yeah. Yeah, I think that's Roger. It looks like it's bleeding into, maybe I read two people's at once. But I would wait, Roger, only because implied volatility going into that event is going to be something. Let's go back to Netflix real quick. So depending on, Netflix earnings, which is on Monday, it's after the market. So Roger, I don't really have a problem with it putting it on at this point. I would think maybe on Monday it's going to kind of spike a little bit more, so you might be able to get a little bit more money from it. Plus it's going to be a little bit more clean on Monday because I would put these trades on for the earnings in the second half of the day where that move's been made and I'm not taking on unnecessary risk on one side or the other. So tomorrow, if you put on the earnings trade today, yesterday, or whatever, if you even put it on Tuesday of this week, that's pushing up closer to your strangle. Whereas I like to put it on for an earnings trade, say the day of if it's coming out after, or the day before if it's coming out in the morning, because you're getting really close to where it's trading, and that way I don't have the probabilities of it going into the money on one side or the other because of a rally or a sell-off. I like to have that probability of one standard deviation in line, at the close for the most part, as close as I can get to that. Does that make sense? Because if I did it on, say, the 13th, this bit of a rally from 6 to 11, my probabilities on my call side of being touched or being in the money have completely changed since I put that trade on. Tovi is asking, why do I use the monkey bars? I like the monkey bars in the market profile because it gives me an idea of where the most time and volume has been spent, which is what the overall market thinks is value. So the idea is it's going to want to revert back to where everybody thinks value is. And that's why I look at that. I started out in college with a psychology major and switched over to finance because I started trading in college, and then moved to Chicago to start trading. And I always said I thought my psychology education was more important to me on the floor than it was having a finance degree. So the monkey bars, the market profile, which we used to call Stoudemire, he was a guy on the floor that came up with this, is psychology, and it's where the psychology of the market thinks value is. Same thing, I use candlesticks only because that to me is psychology of that given day, whether the bears are winning or the bulls are winning. So I look at all of this stuff as psychology. Same thing with the Fibonacci. I don't know if I necessarily believe that these are necessarily reoccurring, numbers in the environment and whatnot. I think that there's so many people that look at these that it comes to fruition. So that's the way I look at that. I hope that answered your questions. Roger's saying, I hope to sell off any profit on Monday and get back in before the close. Good idea. Somebody else, Nick is asking about, or sorry, John's saying, all right, I already answered that question. Okay. Oh, so Tim's saying on Monday is an analyst call. Okay. Thank you, T. All right, let's look at Goldman Sachs. Goldman Sachs has got earnings coming out also probably on Tuesday before the market. So this would be a strangle opportunity on that earnings call setup that I did a webinar for Strangles around that earnings. So this is, again, since it's before, again, I would probably look to put this on in the afternoon on Monday, and that way you get that clean number for that one. So it's looking like the ETFs are going to be the best opportunity for us. We could look at like SLV or something like that. I think SLV could be looking at a breakout with this. If it gets much above this tweezer top here, it could really start to blast off, and all these people that created value right around this are going to be getting a little nervous once we break above that value area high and stay up there. So SLV is something I would look to stay away from. GDX is kind of along those same lines with the miners. They've made that top. Problem with this one is, we've gotten a big move up. If it were trading right, had already come back down around this area, that would be something I would really look at. As you can see, it's building up value here, so it could look to have this value area push higher. So this would be an area where if it came back down into this area, I would look to try and put on this strangle around this. But right now, we could look at it, see what the IV is, because the IV looks pretty good too. So I already have on GDX in there. So let's look at GDXJ, which is the junior gold miners. So junior gold miners, 48%. If you notice in there, it's over here. This gives you more detail as it goes into the tenths. This rounds it up, but this being an ETF above 30 is good. So I kind of like this one. Again, it's kind of along those lines of the GDX, but this is the juniors. And they usually move kind of lockstep with each other. So, like I said, we're looking at the 15, 16 delta, okay, because that 16 delta is the one standard deviation on either side. And, a lot of times you're kind of looking at about a tenth of what the underlying is to collect in premium. So 30 cents, something like that, is pretty good. I usually like to have a little bit tighter markets than this. As you can see, they're 15 cents wide. So that's one of those things that, the downstroke with having the juniors is it's a little bit wider market. So, but for an example, we could always put this in and let it play out. But I'd put GDX on my short list. I usually, when I'm doing these, write them all down kind of. I had GDX on here also. Let's look at one that I did put on because it was the Brazil thing. I think the Brazil thing's been a little overhyped. So let's look at EWZ, which is very Brazil correlated. And as you can see, we have really high implied volatility. They've had it for a while, but we would hope that it would revert back to the mean and come down somewhere. When I say revert back to the mean, come back down around here, around the mid area, and if not more. But I think there's a lot of implied volatility pumped into this because of this meeting that's supposed to be happening. Omero, I'll look at XOP too. I think that's on my list as well because of the whole meeting this weekend as well. So something like this, it is towards the top end of the trade, but I think that we're going to see it come back down here. So if I could get it somewhere, this is going to act as resistance. The further away from you get it from this, point of control, the more it's going to want to come back down. So I looked at this, it had a high implied volatility. I think that volatility is really going to suck out of it. And so I was looking at the 16 delta, which it's kind of pumped up a little bit here and there. And that 18 is closest to. And I also, it's a pick-em between these two because it's right between the 16 delta. I think that it's a little overdone to the upside, so I look to just move down a little bit on that side. And, I like to at least collect 30 cents for that. And then the 24s on the downside put me down here around the value area. So hopefully it'll stay up and above there. So the idea here is, you're basically selling both of them and picking it closest to the 16 delta. So you would hold down or sell the puts or the calls, whatever you like to do first, and then, sell the call, hold down the control button, which I just forgot to do there, and then click it, and that adds them together. So that's how you would generate that strangle, and we would collect 81 cents for that. One thing, the buying power effect, which means the margin you're going to have to put up for this, is usually, add a zero to it. It's 10 times what it is. So TOS is going to have you reduce your margin by $280 $5.90. Probably they're going to round it up to 286 or something like that. So that's how you would figure out the margin on basically anything with this strategy. Raymond's asking how to figure out the margin. Just add a zero to it on anything. So if it's Apple, at around $110, you're going to have to add a zero to it for every one lot. Or for every, for a one lot, you add a zero. 10 lot, you're going to add 2 zeros. Does that make sense? The May 16s are about 30 days out. Yeah, 35 days out. If we were entering this trade on Monday, it's going to be 31. The next cycle, depending on the underlying, you can go into the weeklies and hit that 45 days. But if we're just looking at monthlies being 63 days versus 35 days, I usually go towards the closer end of, or the shallower end, 35 days, 30 days, just because if you remember that graph of the theta decay, 35 days is right inside that wheelhouse of the real theta decay happening. And that's really what I want to take advantage of, rather than being 60 some days out where that slope isn't as steep. So assuming that going into this with the EWZ, we can see it's had implied volatility held up for quite some time. So there's a lot of premium pumped into that because of the fear. It's also held off on that theta decay. So once that volatility comes out, we get that theta decay really happening fast, and the premiums get sucked out quickly. So that's what we want to take advantage of it in here. Trevor's asking, how can you make this strategy IRA friendly? I've done this on several different aspects. You could basically end up buying a far out of the money call for almost nothing, and you could go way up here and buy it for cheap, and it'll act the same way because you've capped off your risk. You haven't really limited your risk by buying something out in this area for 6 cents a nickel. I'd do the first one I could do for a nickel, which seems like this one would be the best candidate for it. And like I said, you haven't really limited your risk to the upside because there is a lot of risk in there, but it makes it IRA friendly. Does that answer your question there? You don't always, I don't think most IRAs, and from what I understand with the IRA is you don't always have to buy the put in there for that to be appropriate. Just the calls. They're only worried about the upside. They don't worry about the downside, I guess, because the rule makers think the market always goes up and never goes down. So just buy the first one that you can find for a nickel and buy that one in, and that makes it IRA appropriate to make it act the same way as we're looking for here. All right, so that would be something if you wanted to get some Brazilian stuff in your portfolio that I would look at, because that meets the parameters. 16. Didn't have a 16, so I rolled it down a little bit to get that 30 cents at least for something like this. Another one somebody was asking about XOP. Let's look at XOP. The other one could be USO also. This is the exploration, which I don't really foresee a whole lot of exploration going on with these markets. I also think that oil is a little overdone to the upside, because I don't think that they're going to come up with an agreement this weekend. I think it's basically a stag party. All these guys are going to get together and smoke cigars and drink wine or scotch or something. Russians are going to be there, so maybe a lot of vodka, I don't know. But I think it's a little overdone to the upside. So I would look at, somewhere, anywhere above, 34 here. And, I don't see it going much lower. I don't really see us going down to these ultimate lows that we saw down here. It is possible, but I would like to see it, or I would think it would want to be right here at this point of control, because once you get way down here, you guys, the cost of storing that oil just almost eats up any profit that's there. And I don't see it going much higher because, for one, I don't think they're going to come up with an agreement. They probably want it up here, but keep in mind, the Saudis and OPEC does not want us in North Dakota fracking. And if we become profitable in North Dakota, then we can streamline that process and lower our costs of recovering that kind of oil. So they want it to go a little higher, but they don't want it up into the 60s and 90s that we've seen before, or even 100, because then we're going to be opening up more wells and everything else. They want to keep us, treading water up there. Can you do these on future options? Absolutely, TJ. As a matter of fact, this is, I used to do these in the corn and beans and things of that nature. So you can definitely do these on future options. You have to be cleared to do that. Not everybody's cleared to do that with TD Ameritrade. I think it's relatively easy, but not everybody. So you could do this in /CL if you got some deep pockets. And if you do have deep pockets, I would suggest doing it because, then you can do lower quantities and lower your cost of implementing these trades for the exchange fees and stuff. So anyway, so this would be something I would really consider, because I think it's going to come off a little bit. And again, since I'm slightly bearish on this, I might tighten up my short or come in a little tighter on my call side. So I would originally look at the 16 delta on here and the 16 delta over here, and I'd probably go with the 28s on this, even though the 19s, it's here nor there, but so the 28s would put me below this area here. So that's why I would roll it down, because I think the market's going to be slightly bearish to this. So I would look at the 28s and the 37s to the upside. I might even tighten that up if I'm that 37 is way up here. I might roll that down, thinking this is going to be a resistance area. So you can cheat those. The idea is the 16 delta is the one standard deviation, but you could, if you're going to roll it down or you're slightly more bearish, that's how you can adjust this market neutrality, that you're taking on a little bit more risk. One thing to keep in mind with this strategy is, don't panic because the market's rallying up. The probability of, when we're talking about the 16 delta, the probability of touch of an option strike is twice the delta. So the probability, for instance, of this 37 strike being in the money at expiration is about 16%. There's only a 16% probability of this being in the money at expiration. But the probability of XOP's underlying rallying up to touch this 37 strike, so probability of touch of the 37 strike is twice the delta. So there's about a 32% probability that the market will rally up. And how do I come up with that number? That's just a number we used to use on the floor, probability of us getting touched. And I'm sure somebody's done a lot of work and come up with that, but it's kind of like a trader cheat when you're on the floor and you're looking at your deltas and everything else and trying to figure out your probabilities. Same thing like what I mentioned with doing what these guys do with Texas Hold'em. They're figuring out their probabilities of a Jack 10 versus, if the guy has, pocket aces or something like that. So, you're always looking at probabilities, because at the end of the day, the probabilities are the probabilities, and sometimes probabilities get tested and they don't work out, but over time your probabilities are going to work out the way they're supposed to. So just because you get tested on a few of these the first time you do it, don't close it out for a loss necessarily. Just remember your probabilities are in your favor with this strategy. I recommend putting in a buy stop or a sell stop to protect the futures options you sold. Nick, no, I don't. But I'm one that is actively involved, and if you're looking at it on a daily basis, which most people do when they're trading these, then you would look to manage this as you go. Some people would put this in, and I've done it before on something that I don't look at a lot about, or I think I'm getting close, let's say, and I'll put in a GTC to sell it at 50% of my max profit. So on this particular strategy, if I were going to sell this 37, or I'm going to go with the rule of thumb with the 16 delta, and I'm a little bit slightly bearish to this side, so I'm going to hold down control and sell that one to add that in. And once you enter this strategy, your credit's 66 cents, so you could put in a GTC to buy this back at 33 cents, like right away, as soon as you got filled. And Raymond's asked, do I define these positions? Excuse me, to create an iron condor? Absolutely. Sometimes I do. And in that regard, then I would, I have other rules that I really don't have time to go into right now. But I've done webinars on the iron condor, and when you're defining a strangle, that's the iron condor. So you can check that out also. The other thing to note on this, if this market does rally up and I get tested on this 37, maybe it blasts up really quickly and goes to 38, 39, I am going to roll these puts up because they're going to be pretty much worthless. If we figure it goes from simplistic scenario, just to think of it quickly, if this happened really fast and went from where it's trading now at 32.50 and rallied up to 36, 38, 39, so we can look at this as if it was up in the 39s. We've rallied about seven ticks on this. So if this were 7 ticks, 1, 2, 3, 4, 5, 6, 7, you can see these options are worthless if it's gone up that much. So there's no sense in holding on to that at that point. You've gotten all your decay out of this, and now you're kind of looking to manage this position. I would roll this up, these 28 puts, to the 37 puts that I had sold and collect more credit for it. I'm probably going to collect another, probably 50 to 70 cents or something like that. So not only have I collected more credit, I've increased my break even by whatever credit I've received by selling those puts. And you want to do that rather quickly, especially if you're starting to get a little bit nervous. Now, if this goes on and it continues to rally up, or on the other side goes down and you've had to roll those down, I usually let the one that I rolled down expire worthless, and what I'm going to do is roll this out in time and roll those puts or calls, whichever one are in the money, and collect some more premium for them. One thing to think about for this is that if you've had to do that, some people are like, well, you're in the money and yeah, you've lost some money there, but there's the other side of it is, if we were looking at these as 28 calls that were now in the money, these 28 calls over here have about 30 cents in extrinsic value. So that's money that you can collect and roll down your cost basis for it. Does that make sense, you guys? This is still along the lines of defending these positions. So, for instance, these 37 puts have around 30 some cents in extrinsic value that can be collected over time. So what I've done with like GoPro, I started out with a Strangle in December. I still have on my GoPro short, what is it, the short puts in there that I've continued to roll out in time. So I've had to do that because they were in the money. So I'm short the 15 puts in GoPro, and if you know anything about GoPro, it's trading around 13 cents or $13. But I've collected a total of about $3 in overall premiums by continually rolling those puts out in time. And yeah, they're in the money, but now if you've seen, GoPro's rallied because they've got the vice president of Apple's design team coming over to GoPro to kind of make that bulky camera probably a little bit sexier, I guess. And you know, it's had a nice little rally. So I'm actually making money on my GoPro despite the fact that I'm still in the money on those puts. So as the market comes up, I'm hoping that you know anything upwards of $12 is making money since I've had these on in December. So that's the importance of, you know, if this is gone in against you and you're in the money, you can continually roll that out and do that well before you get assigned on it. You know, there's assignment risk at any point in time, but your assignment risk increases the closer you come to expiration. So, you know, you want to roll those out when you've got like 10, 15 days before you have inside of 10 or 15 days. So in this regard, to defend this strategy, if this rallied up and was trading around 39, I would roll these puts up and turn it into a straddle, if you will. And if it continued to move up or stayed around in here at expiration or near expiration, I would let those puts die on the vine, and I would roll out my calls in time and collect more premium, and then just do that until I became profitable. Does that make sense for everybody? That's how you defend this one, and that's really important, especially because it's a naked strategy. So again, we're going to do this, collect the credit, know our probability is going to be on a 16 delta, about a 32% chance, or 1 in 3 I'm going to get tested on either one side or the other. And if it goes through me, I immediately roll down, collect some more credit, and hope that it stays right around there. And if it starts hurting a little bit more, I'm going to roll this out in time, the one that's tested and in the money, roll it out in time, continually collect credit for that, and then you know, wait for it to come back, because markets do come back, and as soon as it would come back and hit my 28s or become profitable, usually that's when I'm going to get out of that, as soon as I can get out for basically a scratch. Now, of course, I haven't done that with GoPro, only because I think that news is starting to come out with this Apple vice president coming over to GoPro, so I think there's a little bit more upside to that. So that's why I've kept that one on. I've done the same thing with Twitter, where I've had to roll that out. It's still not profitable, but I've collected over $2 in premium rolling that out in time with my Twitter that's against me, and hoping that that comes back as well. So that's the strategy when you have one of these strangles go against you. You know, more times than not, these are going to die on the vine, if you will, and we're going to collect those credits on both sides. But when it doesn't work out, and it, you know, won't work out sometimes, be aggressive on your rolls collecting premium and continually do that, because you can lower your cost basis, which increases your probability of a win on that. Does that make sense for everybody? All right, good. All right, so that's about all I got for you guys. I mean, we're right there at around an hour on the day. There aren't any more questions. I'll start wrapping this up. All right, so this is trial membership offer, 1 month for $7. You get the daily market commentaries like I talk about. I basically go into every single trade that I'm looking at and or implementing. I go into how I am defending those. You know, I mean, I just talked about rolling my SPY calls out again. That's another thing that I've had to be defensive with. I've done, you know, iron condors and strangles where I've had to roll them. I'll tell you guys the day that I rolled them, you know, and I talk about those in the daily market commentaries and go into detail as to what I was thinking when I put on a trade, why I defended it, how I defended it, and I tell you when I get out and where I took my profit. I tell you, you know, the credit I got for it, or, you know, in the rare occasion that I buy an option, what I paid for it, and then I tell you what I, you know, received to get out or paid to get out. So I go into detail on those. You also get the lesson videos, which are videos about strangles, call spreads, collars, everything there, but not in an hour-long webinar type setup. They're about 10-15 minutes where I go in really quickly and talk about some of the details of those. So they're kind of little refresher courses, I guess, if you will. And then the webinars where I go into detail over an hour, you know, try and answer some of your questions, things of that nature. Also, if you guys are signed up for this and you guys are doing some active trading and something is a trade that you're looking at, or maybe a trade has gone against you and you want to ask me about how I would defend it or what I would do, I can tell you what I would do, and then it's kind of up to you guys to either do that or not do that in your own way. Like I said, I can't give you a recommendation, but I can tell you what I would do and how that meets my my rules that I look at for that. So Nick's asking, when do I finally take a loss if the market continues to go up? One thing that I will look at for something like that is I look at 3 times the credit I receive. So if I, you know, was looking at a 60-cent credit, you know, when it's 3 times that, so we're looking at $2.40 is usually where I would look to get out of that. I don't like to go over 3 times what I'm getting beat up on. So great question, Nick. So 3 times the credit received is usually where I'm looking to get out of something if it continues to go up. But if I still have the thought that, you know, I still have my mindset, nothing's changed there, then, you know, like with this SPX, or sorry, the SPY that I have on, the short calls that I've continued to roll out, it's because I'm pretty bearish on the overall economy, the economic outlook. So I'm looking for a bit of a correction there. So that's just the reason why I've kept that on. So just trying to lower my cost basis on that and increase my probability of it. You know, now if it doesn't have to go all the way down to where my short calls are, because I've collected enough credit that, you know, it's a few dollars higher than where my short calls are, that I would be at a scratch. So, and then these, you know, like live workshops, like I said, and, you know, I'm more than willing to talk to you guys. Please reach out to me via email, and you can reach out to me at trading@protraderstrategies.com. Also in that, how quickly do I, on a trade gone wrong, Trevor, I'll respond to you as soon as I get the email. I mean, I'm good about that. So I don't want you guys to be on the hook for very long, just because I know how I am when I got a trade going against me. I want I want answers, and I want them now, right? So I try to respond very quickly to anybody. I mean, the day I get it, I'm trying to get it back to you. So I want you to have a little peace of mind there too. And in that chat box there, you guys, there should be a link there to that offer. You can also, like I said, reach out to me at trading@protraderstrategies.com. You can also contact us at 310-598-6677. And you know, write to us also if you guys have some option strategies that you want us to look at and do a webinar on, something along those lines. You know, give us some ideas. You know, we're more than happy to tackle that, and you know, I would love to do some of your guys' ideas too. So, and later webinars, we're going to be drilling down on these trades I find where I find them appropriate. But this is that link for the special offer also. If it's not in there, I think it should be in there though. But that's all I got for you guys today. I hope you guys have a great weekend. Thank you very much for joining us. I appreciate you guys sticking around on a Friday after the markets have closed, and some of you guys are probably trying to do this while you're working as well. But that's it. And if you can't take that, take it easy. Trevor asking about a calendar. We'll look into that, Trevor. Thank you very much. Appreciate it, guys.